Welcome to PFA Associates, a retirement and income solutions firm.
Hello, my name is Paul Fair. My company, Paul Fair Associates, is a registered investment advisory firm providing retirement and income solutions. I have over 23 years experience assisting clients with their financial goals. In this video, I'd like to review an investment strategy designed to reduce account fluctuation and save money. Winning is great, but as we all know, you don't always win in the stock market.
This is a review of the PFA Hedging Strategy portfolio. This is not a hedge fund, but a managed strategy created with the objective of helping clients avoid major losses in the stock market while taking advantage of market upswings. As we all know, the market goes up and down. The best scenario is to be in the market when it's going up and out, or at least in a position of making gains when the market is going down. The objective of a hedging strategy is to minimize or avoid losses or even make a gain when the market is in a downtrend, while providing gains when the market is in an uptrend. Downside protection is an important aspect of this strategy. If you were investing in the stock market between 1980 and 2000, you were probably happy with the returns, even with a 20+% one-day loss in October of 1987. However, from 2000 until now, the market has been very erratic. It's exciting to get an 86% gain, but not good if it's followed by a 49% loss and all the gains are wiped out. Taking a longer view, we see that the market was in an uptrend for 20 years. However, the market has been in a roller coaster ups and downs since 2000. Many investors have actually lost money, more importantly, lost buying power. After all, $100,000 buys less today than it did in 2000. Is your portfolio positioned for the next major move in the market? What will be the next direction in the trend of the market? How long will this trend or the next trend last? We're going to review the makeup of a managed hedging portfolio to see how this model was allocated at the end of each quarter from the end of 2007 till the middle of 2012. The primary investments used in this portfolio are the NASDAQ 100, which is a traditional mutual fund, corresponds to the NASDAQ 100. If the NASDAQ goes up, this goes up. NASDAQ goes down, this goes down on a 1-to-1 ratio. The objective is to hold this during market uptrends. Second, the NASDAQ 100 Inverse. This is a non-traditional mutual fund. It's an inverse or hedging fund. If the NASDAQ goes up, this fund goes down. If the NASDAQ goes down, this fund goes up on a 1-to-1 ratio. The objective is to possibly hold this fund in a market downtrend. The third fund is a long-term government bond fund. If long-term bonds go up, this fund goes up. If long-term bonds go down, this fund goes down. This is on a 1.2-to-1 ratio for both losses. This color-coded chart represents all three mutual funds from 2008 till mid-2012. As you can see, all the funds have fluctuated over the time frame. As we go through the illustrations, you will see a circle which represents the position of the investment at the end of each quarter. This should not be interpreted as the only trades made. As an example, in 2008, this strategy produced 11 signals, but the chart only reflects 4 quarterly positions. At the end of the first quarter of 2008, the model was also invested in the government bond fund. At the end of the second quarter and the third quarters of 2008, the strategy was invested in the non-traditional NASDAQ 100 or the inverse hedging fund. At the end of the fourth quarter of 2008, the investment position had changed to the government bond fund. By the end of the first quarter of 2009, the strategy had changed positions to the traditional NASDAQ 100 fund. This also was the investment position at the end of the second quarter, the third, and the fourth quarters of 2009, as well as the first quarter of 2010. At the end of the second and third quarters of 2010, the investment strategy held the government bond fund. At the end of the fourth quarter of 2010, the investment had changed to the traditional NASDAQ 100. At the end of the first quarter of 2011,
2011, the strategy had changed to the government bond and was in this position at the end of the following 3 quarters.
At the end of the first quarter of 2012, the strategy was positioned in the traditional NASDAQ 100. At the end of the second quarter of 2012, the strategy had changed positions to the government bond fund. No one knows with absolute certainty when the next major market move will occur, or whether that move will be necessarily up or down. Obviously, investing in stocks and bond markets always entails risk, and no strategy is guaranteed to work all the time.
Over the years, our management strategies have evolved and adapted to the changing market conditions. As an example of our philosophy, in September of 2000, we recommended that our clients reallocate their investments to a guaranteed fixed account earning over 4.5%, then recommended moving back into the market in 2003. More recently, we implemented the PFA Hedging Strategy portfolio, which aligns with our management style. For example, in 2008, the S&P 500 lost nearly 40%. At the same time, this hedging model produced double-digit gains. If you're intrigued by the PFA Hedging Strategy portfolio and would like additional information, contact me so we can start a conversation specific to your goals. Additionally, income-producing portfolios and guaranteed income vehicles are available. I hope you enjoyed this presentation, and thank you for your time.